Well, good afternoon. This is Mark Milam, your mortgage professional. Let's talk about credit reports and credit scores. Credit scoring may be the single most important factor in determining if you're going to qualify for a loan, and if you do qualify for a loan, what your interest rate, your closing costs, and your mortgage insurance might be if you're not going to be able to put 20% down on the mortgage. Now, most lenders pull what's called a tri-merge credit report. Tri-merge means there's three bureaus that are going to be reporting a credit score for you. These are Experian, TransUnion, and Equifax, and lenders are going to take the middle score of the three scores to determine what kind of interest rate you're going to get. If it's a joint credit report, a husband and wife, boyfriend, girlfriend, whatever it might be, we're going to take the lower of the two middle scores to determine rate, cost, and mortgage insurance. So that's important to know. What kind of debt shows up on a credit report? Well, there's principally three different kinds of debt that might show up on a credit report. There's revolving debt, installment debt, and mortgage debt. So revolving debt is essentially credit card debt. Now, this might be your revolving credit card like a Discover, a MasterCard, or a Visa, or it could be an open credit card like an American Express, the kind of card that has to be paid off every single month. And when you think about credit card debt, you really need to think about utilization. Utilization is the key. How much margin do you have between the credit limit and the amount you're utilizing? So frequently I'll have clients who, if they pay down the balance on their credit card, actually improve their credit score prior to closing, which improves their interest rate, their closing costs, and if applicable, their mortgage insurance. But the same effect can sometimes be achieved by simply raising the credit limit on a credit card. If you need to preserve capital and not use it paying down your balance, you can simply raise the credit limit and sometimes achieve the exact same results because you're achieving the same utilization. The second kind of debt that shows up on a credit report is installment debt. When you think about installment debt, think about a fixed term with a set payment to pay back a given liability. These are things like student loan debt or auto loan debt or even a personal loan. So when you think about those kinds of debts, utilization is not near as important. It doesn't play near the factor. You can't pay down an installment debt and achieve the same kind of score improvement that you might be able to achieve by paying down revolving debt. But one thing to know about installment debt, something that's very helpful, is if there are 10 payments or less remaining on your installment debt, most lenders can exclude that debt from counting against you in qualifying for a mortgage. So if you have an auto loan with $5,000 remaining and you have a $500 a month payment, we can exclude that $500 per month payment if it's a true auto loan and not a lease. So very important to know when you're qualifying for a mortgage that you can leverage paying down installment debt to help qualify for a higher loan amount if you need that. The third kind of debt that shows up on a credit report is mortgage debt. And of course, mortgage debt is probably the most important kind of debt to a mortgage lender. That's what we care about, that you're going to repay the loan. So if you have to be late on any liability, you want to make sure it's not your mortgage debt. As a matter of fact, late payments on mortgage debt in their most recent 12 or 24 month period can actually knock you out of qualifying for most A-paper mortgages, most of the best rate mortgages. So you want to be careful there and not be late on any mortgage debt. Some other types of liabilities that might show up on a credit report are collections. Most people seem to think that they need to pay their collections off prior to applying for a mortgage. That's not always necessarily the case, especially with medical collections. You don't necessarily need to pay those off. There's also judgments or tax liens that might show up on a credit report. Those typically do need to be paid off prior to closing on a mortgage loan because those liens actually sit in first position on title and knock the lender into second position, and most lenders are not going to accept that. I hope this information has been helpful for you, and good luck.